high inflation means we're basically spending a lot less time developing new products, new research and development, etc. And more of our time is just spent trying to keep up with the price changes. And slowly over time, it makes your economy less and less efficient. We all end up poorer, basically.
Welcome to Tea with Tony. If you haven't already noticed, life in New Zealand has just got more expensive. We asked Tony if we can handle inflation of 3.3% and what that means for the housing market and interest rates. Hi Tony, how are you?
Good, thanks Lenska. Good.
Nice to be in Wellington today.
Yeah, not windy yet.
No, it's actually rather nice out there. Look, I'm going to start a little differently today. I'm going to read you back some of your own words that you've recently written. A famous economist once said, "The 1970s taught us that high inflation destroys the wealth of those without enough power to keep raising their incomes and crushes output per capita. The latter happens as people and businesses focus more on protecting themselves against cost increases than developing new products and boosting productivity." Okay, so annual inflation has hit a near 10-year high of 3.3%, with prices increasing 1.3% alone in the 3 months to the end of June. Should we be worried?
Only if it stays like this for maybe another 12 months or so. We know a key contributing factor is temporary supply chain disruptions around the world, so shipping costs have gone up, used car prices have gone up, construction materials, etc. The difficulty is, the longer the temporary period goes on, the stronger the chance that you and I and other people will start thinking, I think inflation is going to be above 3% for a long period of time. And that then becomes dangerous because the Reserve Bank is required to try and keep inflation around about 2%. And of course, they'll have to react to slow the economy down, raise interest rates until we are convinced again inflation will settle at 2%. So the coming year is going to be a bit experimental in that regard, and we better hope it's a temporary thing.
So thinking of everyday kind of Kiwis and how you interpret this, how did the rate get set? Obviously the brains at the Reserve Bank, between 1% and 3% is their remit, but why is that, and why is that capped at 3%, and do we sort of all freeze when it goes beyond there?
Yeah, around the world central banks and governments have settled on 2% seems good. If you try and target less than 2%, too often you'll be running the risk of deflation of prices falling. That's very dangerous because if I think the price of a couch is going to fall, I'm not going to buy the couch. I'm going to wait 6 months till it's cheaper. And of course then the retailer goes out of business and the manufacturer of couches. And the issue here, of course, is more one of high inflation. If I think something's going to go up in price, yes, I'll buy it soon, but I'm going to be spending a lot of time trying to buy something before it goes up in price, and maybe my wages don't keep up with inflation. And so if you don't have unique skills, strong bargaining ability, all of a sudden you're actually getting poorer over time. If you've got products which are in demand and so you can just set whatever price you want, you're sort of away laughing, but there aren't many businesses like that these days. So high inflation means we're basically spending a lot less time developing new products, new research and development, etc. And more of our time is just spent trying to keep up with the price changes. And slowly over time, it makes your economy less and less efficient. We all end up poorer, basically.
So it kind of burns a hole in the money that's in your wallet, doesn't it, if it tips too far? And what about those on lower incomes? You kind of hinted at that. So their everyday living costs increase, don't they? And their disposable income becomes more challenging. So it's definitely something you want to keep in control.
Yep, definitely. For people on lower incomes, a lot of what they're spending their money on is sold by businesses with a bit of bargaining power. You know, supermarkets, for instance. So for the food expenses, etc. Whereas maybe unless you belong to a strong union or you've got unique skills, you might not be able to get an annual wage increase that compensates for that inflation. So this is what the 1970s taught us, that for the people at the low end of the spectrum, they usually ended up the worst off in terms of the purchasing power of their income after a few years.
So that quote from the beginning, around 1970s, and there is that kind of fear factor around that. Do you think we're heading back in that direction? Should people be worried, like I said before?
Yeah, we're not going back to the 1970s.
Yes.
Back then, businesses put up prices, unions get higher wage increases, businesses put up prices again. We always worried about wage price spirals. Well, I don't at all see that happening this time around. We've got a lot of new technology, more efficient processes, etc. out there. more international competition, and really it's just a matter of how long will central banks wait before they start tapping back against strong growth, which is partly driving inflation, by raising interest rates. So that's the important thing around the world now. When will the Federal Reserve in the United States decide their inflation at 5.4% is too high? Is it really temporary? When do they raise interest rates? In Australia, when will they start raising interest rates, especially in light of what's happening in New South Wales, for instance? Here in New Zealand, there's a good chance we could be first cab off the rank with interest rates possibly rising on August 18. Maybe an 80% probability.
So essentially when this piece is live, towards the end of its tenure, we could be seeing rate increases, and that's kind of the next thing I wanted to talk to you about because it segues really nicely. But before we do, some quite funny anecdotes. So, well, some of them not so funny actually. Shows have gone up 10%, I say. I'm really unhappy about this, Tony. Any other sort of things that you found interesting on your travels around inflationary, key items for groceries, vegetables, that kind of stuff is really kind of...
Yeah, obviously food items, but often they're more affected by weather conditions, this sort of thing. Meat prices are rising very strongly. That's partly because the rain has fallen in Australia, so the farmers are holding beef cattle back to rebuild their herds. There's a shortage of beef meat on the tables in the markets over in Australia, so it's pushing up meat prices there, and it's an international commodity. Meat prices go up here. Computer chip shortage, so there's not as many new ones coming on to the market. Rental companies not after 3 years, selling off their rental stock. They haven't been renting so many because people haven't travelled quite so much. So a lot of things across, there's 649 individual things go into the basket measuring inflation in New Zealand, and a great number are increasing in price. It's not just one or two.
Not just the shoes. Okay, good to know. Interest rates are already on the move based on swap rates or the cost of money from overseas, not to use jargon terms for you. We talked about a likely shift in August with the OCR. I know you've got some quite strong predictions around rates. Talk us through those. Yeah,
basically I think people should be anticipating that the Reserve Bank will increase its overnight interest rate by about 2% over the next 18 months. So whatever 1 year fixed rate a person is paying at the moment or a floating rate, add 2% on, and that's probably where the rate is going to be in about 18 months' time. They could increase more than that. We really don't know. Every single time our central bank and central banks overseas either increase interest rates or decrease them, you never know exactly how people are going to react. Sometimes people are very sensitive and they don't have to increase interest rates all that much. Other times we go, yeah, no, I'm fine. I'm prepared to pay the higher interest rate, and then they have to take them up quite a way, as we saw in New Zealand in 1998 and 2007, 2008. This time around, I guess the good thing is that probably 80 to 90% of people owing money on their house, all they know is low interest rates since 2009 and falling interest rates. So once the interest rates start going up, being pushed higher by the Reserve Bank, it's going to be quite a shock to a lot of people. They'll be able to afford the repayments. The banks have already worked out their ability to service that at higher interest rates, but it does mean they'll have to cut back on other discretionary spending, travel to the GC, extra couches and these sort of things.
Spa pools,
the gazebos, the decks, all these sort of things. Yep.
I think there's a bit of a misconception, or it's useful for people to understand that when you come to a company like NZHL or another provider, your affordability for a mortgage is stress tested against a higher rate, not the current rate, which is what you alluded to before. So there's some safety mechanisms built in, isn't there? Do you want to sort of talk people through how that kind of works?
Yeah, it means that although we're going to see interest rates rise to maybe a little bit more, percent over the next 18 months or so, that's not going to cause a big decline in the housing market. It's going to cause people to pull back in spending in other areas to meet the interest payments. But when people have been borrowing money over the past few years, the lenders have been working out their ability not to keep servicing the debt at a 2.5% or 3% interest rate. It's at something sort of 6.5%, 7.5%, a couple of years ago, 8%. So people will be able to service the debts, but they're going to have to pull back on discretionary spending at the restaurants, the bars, the holidays, that sort of thing. So operators in those sectors should anticipate a bit of a pullback eventually once the interest rates do get up there. Initially this year, small rises. It's more going to be the story for 2022, 2023.
And probably those ones, first-time buyers or people that are a little bit more stressed financially already, they will feel it the most. Is that correct?
Well, yeah, those people who basically have the debt most recently taken on board have probably got the largest debt versus their income, so they're going to be in the most sensitive position, but not in terms of debt versus the value of their property, in terms of house prices falling. No, it's more going to be their debt servicing costs going up as they roll off probably the 1 year fixed mortgage rate, and they're going to have to cut back spending somewhere else. And so they might have been thinking, we've got our house, then the borders are going to open up, maybe in the second half of 2022, we're going to go for a trip to London. Well, maybe that won't happen because they'll have a mortgage to service.
So I guess now's a really good time for me to mention that in these situations, NZHL is a business that actually does really well when there is less money sloshing around. And the reason is because people start to think about how can I economise with what I've got or make the most of what I've got, and that's what we do.
Yeah.
So, you know, we're seeing a lot of people starting to come and see us and go, okay, I'm a little bit concerned, and our guidance is always, look, think about what you can control. You actually can't control the interest rates, no matter how hard you try. Not even you can do that,
No.
Tony. So we can give you other ways. Look at your structure, start paying attention to these things. And it's like anything, what you pay attention to, you get results from. So that's kind of an NZHL guidance, and don't panic. You know, like there's a way through. If you've been lent the money and you've got a job, you're generally going to be fine.
Yep.
Now, look, I'm going to close us out with our favourite topic, a personal favourite for you and I, is the housing market. So, anecdote for you, it's been a record year for NZHL in terms of NZHL submissions, loans. Last week, we had a record day. Things are not slowing down in our world. I mean, there may be pockets of that, but things are really still boogieing along. What's your take on the market given rate rises and inflation?
Yeah, I think the investors have done the worst of their spitting the dummy phase there after March 23, and while the real estate agents and mortgage advisors generally are still saying there's fewer investors out there, the intensity of the investor withdrawal from buying is easing off, so they're starting to sniff around again. FOMO, I've got an explicit monthly gauge of fear of missing out. I can see that measure starting to come back up again as well, and I can still find zero statistical evidence of a wave of selling by investors in response to the changes announced by the government or the LVR changes, etc. Some have sold, but they were probably going to anyway within the next 2 years. They just decided to do it now instead. So I still believe on average house prices increase 5 to 10% over the coming year. Beyond that, I think we are looking at a flatter period because the migration will be relatively weak, the interest rates will be higher, and there'll be a lot more house supply in the market as well. Having said all of that, construction costs are rising so strongly, there will be some people, especially with sections around the country being in short supply, going, well, I'm simply not going to be able to get what I want built. I'm going to start looking back at the listings again. So, but once we get beyond, let's say, the end of 2022, more and more people are going to be saying there are more houses getting built, and I think the borders are probably open by then, and a lot of people are going to go to Australia, and expats, why would you leave London and come back to New Zealand for half the wage? So those numbers are not going to be what people were expecting. And of course the interest rates being higher as well are just going to knock back some of the buyers. Again, I don't see an environment of falling house prices. In New Zealand, that pretty much only happens when the economy's in recession, but I do see a flattening out maybe 18 to 24 months down the track. But you're right, the longer it takes to build extra houses because you can't get the timber, you can't get the doorknobs or the windows, etc., it does push that period of still rising house prices out. Who knows, maybe another 6 months, maybe it's not going to happen until the second half of 2023, then things flatten out. Still a lot of uncertainty. There's been no increase in the number of properties being listed on the market around the country. The house price inflation has slowed down, but it's still running at about 10% at the moment. So the government will be happy-ish about that. And all I'd suggest for investors that are looking at this is you'd best hope in a year's time house prices aren't still rising 10% plus, because then the government will probably say, well, we took away the ability to deduct interest expense when you're working out your taxable income. What if we stripped out everything else as well? Maybe that would finally slow the market down. So people should be quite hopeful that in the coming year house prices rise well less than 10%, or the government's going to act again.
And that's interesting too, because for first-time buyers that are concerned about interest rate increases on the other side, they have got in and the asset is still appreciating. So yeah, hopefully there's a cooling as opposed to a or a as you said.
Exactly.
Anyway, look, thanks Tony, really appreciate that. Thanks everyone, thanks for joining us this month. I hope you haven't heard any of the banging in the background. We have a building site apparently that we didn't know about underneath us today. Look, as I always say, Tony is an independent economist. We like it that way. His views are his own and not necessarily those of NZHL and vice versa. Please do comment below or follow us on our social channels, and we'll see you again next month. Thank you very much.